Yeah, hi there. This is Bernhard Koepp from CJ Lawrence wishing you a happy new year. Well, it's been a happy new year if you've been long equities. We finished the year 25% plus for the S&P 500. That's on top of a big year also in the previous year, 2023. So if you've been long equities for the past 2 years, you're up about 50%. That's not a bad return. So look, we're obviously there's a lot of economists and strategists looking at their forecast for 2025. There have been a lot of events in the economy, in politics, geopolitical, abroad and domestically, where people need to look at their forecast. So let's start with inflation. So, inflation was the topic of the last couple of years. The Fed is still in an easing cycle. But it's unclear whether the tail end of the inflation worry that we had in the last couple of years is now really behind us. And if you look at the big components of inflation, that's really wages and shelter. Let's look at wages. I mean, if you look at the sort of 3 or 4 indicators of wage inflation, they're all around 4%. So 4% sounds high, but if you factor in productivity growth, which is about 2%, then you take 4% inflation for wages minus 2% for productivity, you get to around 2%. That's not bad. And if you look at the history of productivity growth as well, we've come a long way. I mean, if you look at the tail end of the great financial crisis in the '09 period, and we came out of that in 2010-11, productivity growth was zero. So 2015, we started finally getting a lift in productivity at about 0.5%. So being at 2%, we've basically quadrupled productivity growth. And that's a good sign that the economy and the technology innovation that we've gone through, whether it's today generative AI or the accelerated adoption of cloud computing that we saw in the pandemic, all these things are actually adding to the economy, which is really positive. Rents, rents are still, rent inflation is still at 4.8%. That's come down a lot from the previous high. So the reading for November was 4.8. We don't have December yet, but the trajectory for rents is really coming down. So we should see relief from rents as well, not just from the wage side, but also from rents. There are a couple of things in CPI that are distorting the numbers. We've talked about this in the past. So auto insurance is still, if you've renewed your auto insurance or home insurance, any kind of insurance, that's still very high. That has a number of factors, everything from heightened risk from floods and the environment. But that's the one sort of distorting factor in CPI. If we look at oil and gas, I mean, that we also see relief there. If you look at gasoline prices historically, in April of 24, they peaked for regular gas around $3.60. If you've filled up your tank recently, regular gas is now $2.75 or $2.80. That's quite a drop. So again, deflationary pressures, or at least there's relief from the gasoline side. Turning to GDP. 3%, not a bad level of growth out of 2024 going into 2025. That translates into very decent, strong earnings per share growth. And of course, as equity investors, that's what we care about the most. There is an acceleration of earnings per share going into 2025, which is something that's missed by many strategists who are bearish going into 2025. We're quite optimistic given how our companies, especially in the technology side, are performing. We're seeing accelerated growth into 2025, which is quite good. The strong sort of secular growth drivers that we've been talking about in the past are still very much in place. So of course, on the technology front, we're talking about the adoption of generative AI. We're only just at the very beginning of this, and it's really the infrastructure build out that you need to roll out this great software that's driving productivity. So we're in that phase where it's still the semiconductors, it's fiber optics, it's all sorts of things that are in power There is not enough power being generated to actually power all of these data centers. The other big secular growth trend that we're watching is reshoring. I mean, reshoring is probably one of the biggest trends happening all over the world, where we've learned the hard way through the pandemic that some very critical supply chains need to be more onshore, but it's also technology that's driving that trend. So valuations, look, I mean, valuations are not cheap, and the pessimists on the markets are saying, well, at 24 times or 25 times earnings for the S&P, and that's on 24 earnings, that's very high. I can tell you, as a portfolio manager for the past 30 years, I've seen very high valuations before. That doesn't mean the bull market comes to an end. It's just a question is how fast are the underlying earnings growing, and how sustainable are they? So if we look into 2025, which just started today, the multiple comes down to 21.6 times. Okay, so we have 12% earnings growth going into the new year. And actually, the earnings estimates looking into FactSet are even higher for 2026. So that's where the risk is, and that's where forecasters can get it wrong. But if you look at it today, looking into the future, this is not a decelerating growth story, but actually an improving growth story, which is something we like to see. Turning to the politics, okay, we have a new administration coming in, so there's a lot of risk associated to the policy side, because we don't really know what's going to happen. But the market is telling us that the market feels deregulation is going to trump the risks of tariffs. So we've heard a lot about tariffs in the last couple of years in the campaign, and also it's not just the new Trump administration, but the Biden administration also has been using tariffs. So tariffs are typically inflationary. They're typically counter to GDP growth, but the market today is saying that the forces of unleashing economic growth through the deregulation side is going to be much stronger than sort of the blunt policy tool that the Trump administration has been talking about, using tariffs. So we'll see if that's correct, but so far so good. Geopolitical, obviously 2024 has been a terrible year when it comes to hot wars and conflict around the world. There's also some, if you want to take a more positive view on that, peace may trump wars in the coming year. So we'll see what happens in the Ukraine, also in the Middle East, and of course, wars are inflationary. If you have more peace and less war economy type growth, that is also deflationary. So we'll hope for the best there. But in short, I mean, also turning to the international side, I mean, the European economies can certainly gain a lot from peace in the Ukraine. China has been talking about fiscal stimulus a few times now, and they are very concerned about a decelerating growth there. So on the international front, we may also get some relief there. So summing up, it's been a terrific couple of years to be long equities. The interest rates are now to the point where you can nibble on bonds as well. Shorter, we're careful about having duration there, because there still may be some inflationary pressures down the road, given the strong growth that we're seeing. But again, it's a pretty good environment to be invested. And again, that's something we've said to our clients over the years. It's more important to be invested, and rather to try to not to time the market, because you can be so wrong, and the last 2 years are a good example of that. So wishing you a healthy and happy new year. Again, you can contact us if you have any questions, and all the best for the new year. Thank you.